Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am going to have my friend Mario Dattilo, who began his entrepreneur career while in high school at the age of 18. I wish I would have known that, and I would have started back then. He began investing in real estate in 2008 and started building a portfolio of mobile home communities in 2015. The portfolio is in 5 states and is managed by Celebrate Communities, Mario's property management company. So we'll talk a lot about mobile home parks today. Welcome, Mario.
Hey, thanks, Alpesh. Appreciate you having me on, and super excited to be on the show. I'm a big fan.
Absolutely. Thank you, Mario. So we start with this question with every guest. Tell us something interesting or funny about yourself.
Yeah, I would say interesting is I never expected to invest in real estate. I really had no interest in real estate growing up. My dad was a builder, custom home builder, and had been in different facets of construction. And so I always thought real estate was moving dirt. And so the interesting thing is here I am, however many years later, 100% invested in commercial real estate. And so I wanted to get into technology when I was in school, and realized that I'm not smart enough for that. So moving dirt and buying real estate was where I landed.
So that's funny. Now, basically, it's a family business then.
It is. Yeah. Yep. Exactly.
So let's talk about, because you didn't want to do real estate, but you started your entrepreneurial career at 18. So you always had that bug. What was your very first real estate investment, and how did it work out for you?
Yeah. So my first business that I started when I was in high school was a network marketing business, which taught me a ton. And I actually did pretty well with it. I made actually very good money doing it for a while. But my first real estate investment started in around 2008. I had I read some books on wholesaling and flipping homes, and I owned a real estate brokerage at the time with a partner. And so I ended up tying up a home on a golf course in southern Minnesota, I guess you could say, which I was in the Twin Cities area, Minneapolis, St. Paul area, and tied it up off of an online news, newspapers have an online classified as well. I found one on there and tied it up with an option agreement of all things, and wholesaled that option agreement. So made like $7,000. And that was just that was a ton of money for me at the time from on a real estate deal that I really had no money in. So it was not a lot of money, but it meant a lot. That first deal always does.
And remember, we are talking about 2008, $7,000 without any money putting in. It's a great deal.
Exactly. The next deal was I think I netted like 70 something thousand wholesaling a large luxury home. So it went from, don't hold me to that exact 70,000. I think it was like around 72,000 or something, but big jump on the second deal. So that's where I really got the itch.
Nice. So how did you get started with investing in mobile home parks?
Had been investing in single family from about 2008 till around 2013. We started to see a lot of the distressed assets getting eaten up, and now we were starting to look at potentially a normal stable market. At the time, at least it felt like, where we would have to then market to homeowners, sit down at their kitchen table, sell them on why they need to sell us their home and all that. We kind of went, this has really become a job. We have to keep trading widgets, or in this case, it was homes, in order to make money. And if we didn't have the next home to flip, we were out of business.
Yeah,
and
we kind of transactional business, right?
Yeah, it's very transactional. And so we decided, let's look at some cash flow assets. And we had looked at renting out single family homes. It was something that we were probably going to be comfortable doing just because we knew the buyer, we knew, or we knew who the tenant would be. We rehabbed, hundreds of homes and but what we realized is that we couldn't control the value of that single family home. No matter how much rent it produced, it was always going to be
Right.
worth what the house next door was
Next
worth.
door, yep.
So instead, we started looking at commercial real estate and, obviously stumbled on apartments. And we're like, well, this is an easy transition from single family
Yep.
residential to multifamily
That's what we
residential.
all do. Yeah.
Yeah. So we're like, well, let's look for some apartment buildings, took some education and started looking at a ton of deals and really was struggling finding deals that made a lot of sense in 2015. Can you believe that? Or
Yeah.
2014? I was like,
And then
we
people
thought
are
we missed the
still
window.
doing apartments, by the way.
Oh, I know they are.
At 4 or 5 cap rate. Yeah. Same
I
thing
know.
I thought.
I wish I would have bought every single thing I looked at in 2014.
Oh, yeah.
But being conservative investors, we ended up stumbling across a mobile home park. And without getting into that whole story, that was the first deal that we pursued. And from then on out, just went all in on mobile home parks. We own a little bit of self-storage as well, but the focus has been mobile home parks since 2015.
Oh, that's interesting. So right now, when you receive a mobile home park deal, what are the things you look at as soon as you receive the deal?
Yeah. First thing I look at is demographics. Is
Okay.
it what are the median household income? What is the median home value? What's the population? Is it growing or declining? And what's the rents on a 1 to 2 bedroom apartment in the area? That's like first glance I need to know. Then I'm also looking at the MSA that it's in to determine the size of that. Because, size of the zip code population wise isn't that important, but the MSA is definitely important to look at. Second thing I'm looking at, flood zone. I'll check the flood zone before I check anything else because I've went through complete underwrites on deals, even went into the negotiations on the contract and then realized, oh crap, I forgot to check the flood zone map
Right.
and it's in a, floodway and you're like, oh,
Yeah,
forget
this is
this.
one
So-
of the thing I check right after. So I look at MSA and then flood zone. So I'm glad that you
demographic, then
reminded.
flood zone, and then I'll start doing the math and looking at the property, jump down on Google and do all that. But you got to know the neighborhood that you're buying in because you can't change the neighborhood. You can change
Nope.
the property to an extent, but
Yes.
can't
I
change the
agree.
neighborhood.
So let's talk about all three. So where do you go to look at demographics?
A quick look would be bestplaces.net. That's
Quick look.
Yeah, if I'm going to do a quick look at demographics just to see those high level metrics that we're talking about, I'm going to bestplaces.net because it's an easy user interface.
Yes.
It's not
Yeah,
too much data.
And it's free.
It's free, yeah. And honestly, we don't pull data from paid sites at all
really? Okay.
for demographics. We just never have. So maybe
Right.
after the show, you give me a few referrals on good platforms to use. Storage, we have a little bit. There's one site that we have a paid account on, but again, for mobile home parks, we haven't. City-data.
Yeah, I was going there. Best places and city data.
Yeah,
two of the best.
So yeah, and that is the reason I don't go to that site first is because it's just a data dump. I mean, it's so much information. If I just want to quickly look, I got to scroll for 5 minutes to find what I'm looking for.
Yeah.
But those are probably the first initial places. After that, we'll check even traffic counts with the DOT and all those different sites manually, but quick looks, it's best places and then city data for a little bit more depth.
That's awesome. So once you looked at it and once you realize, okay, this is the deal, I want to look further. So then can you take us through the underwriting process you go through?
Sure. Yeah. So typically what I'm doing is I'm looking for reasons why I don't want to do this deal. I used to look at deals and go, oh man, how can I make this work? But what I found is you just waste your time because ultimately later on you go, you know what, that actually was a deal killer.
So hey, I'm going to interrupt. This is such a great advice, right? Because every time when we look at the deal, we are always thinking, how can I do this deal, right? This is a great point that how can you stop yourself from not doing this deal? So basically you are removing yourself emotionally from this deal, from the get-go. So thank you for mentioning that.
Yeah, I try and put myself in the shoes of like a bank underwriter, because you know how quick bank underwriters are
Yes.
willing to deny stuff. And it's not easy because you want to do deals, right? You're excited,
Yeah.
especially when you're early on and you're trying to get your first few deals done. We're taught to be deal makers, right? We're taught to be
Yes.
creative and make deals work. But that's good in some ways, but you also have to know what deal killers look like and use
Yes.
those to check them off so you don't waste time. Because I've wasted, I mean, I'm guilty. Like the reason I
Oh
learned
yeah,
this because I made the mistake.
I
I've
lost money
invested
because of the
weeks, yes, weeks into things and money into things and been like,
yeah.
you know, if I would have just killed that deal within 10 minutes
Yeah.
of looking at it, I would have saved myself a lot
Yeah.
of headaches and probably been working on something else. So, um, along those lines, I definitely want to look for big red flags. We mentioned demographics, we mentioned flood zone. I'm going to jump down on Google and I'm going to walk around the neighborhood. If there's bars on windows, if there's
Oh
things
yes.
in that neighborhood, strip clubs, pawn shops, it's definitely a red flag for me. If there's a, I mean, is it a deal killer if there's a pawn shop down the street? Probably not. But it's
Right.
something that raises flags for me that the neighborhood might not be
Yeah, the
attractive.
cars in the trashed cars, window broken, whatnot,
Yes. Yeah, I just, you know, it's kind of a lot of times we get too technical on things before we use common sense. And with Google Earth and the technology that we have, you can use common sense to weed out a lot of deals right up front. So I'm doing that Google Earth search. Then from there, I'm making sure that I've got all the most important information about that property, total lots, total occupied lots. How many of those homes are park owned versus tenant owned, and what's the occupancy on all those? What are the rents on both lots and homes? And I'm going through an entire seller questionnaire, whether it's provided to me in an offering memo, which usually isn't the case because I don't look
Right.
at much that's on market. But I'm making sure that I've got all the most important information about this deal. And then I'm doing a quick calculation back of the napkin. You know, total lots, I'm sorry, total occupied lots multiplied by average lot rent times 12 times, you know, point whatever the expense ratio it needs to be. And then I'm dividing that by a reasonable cap rate on what I think that market should be. And I'm just saying, am I within range of that seller's ask price? I don't even want to waste my time if I'm super far off. And from there, if I'm still within range, then I start looking through the rent roll. If I've gotten that, I'm looking through the P&L, looking for any major issues right away. I used to spend a lot of time modeling all that stuff out before taking the time 2 minutes to skim over both of them to see if there's anything that's just a major red flag,
I see.
you know. And so that's kind of where I start out. And I don't know how far you want me to go down the road on this, but you know, I'm constantly trying to save myself time by doing some of these things. So I'm only spending the time doing the heavy lifting, doing the full modeling out on deals that I think I really have strong potential to pursue.
So, no, this is great. So first you are going through more of like skim through, running through a back of the napkin analysis. And then at what point do you think, do you decide that, okay, this is the deal I should pursue and I should go into heavy modeling or underwriting process?
Yeah. One thing that I've started to listen to myself on, and I never used to do this, and where it's probably counterintuitive to what we're taught on investing, is I have started listening to my gut a little bit more on, and the question I ask myself is, do I want to own this asset? And because you can look at the numbers and they look sweet. You can look at
Right.
a lot of things and it looks pretty good. And then you go, yeah, but it's in, you know, it's in BF Egypt and it's going to be a 4-hour drive from an airport. And I start taking into consideration, do I actually want to own this thing? Not is it a good investment? If after looking at everything, I'm still going, yeah, I actually want to own this asset and I want to deal with whatever problems it's going to throw me. Then I start looking at then I start breaking down the model of, you know, taking the rent roll, multiplying it out, putting it into the spreadsheets. And I, again, I'm not quite sure how detailed you want me to get on this, but um, I do also, before I even start putting it into the spreadsheet, is I put together a business plan, and it's
Okay.
nothing fancy. It's year 1, year 2, year 3, year 4. however many years it's going to take to get that property stabilized. And I just make bullet points. Year one, we're raising rents by this much. We're billing back utilities. You get the point. And that way, then when I go and model it, I'm just following that business plan to see where, so I've thought it out at least for a few minutes before I actually start building out a spreadsheet that's, 10 tabs and
Right.
500 cells later.
Yeah. So that underwriting spreadsheet, is that your own, or do you use someone's smart software, or?
It's my own. And to be honest, it probably didn't start out as my own. It's been modified so much over the years, but it's a spreadsheet. I'm not using any sort of software to do it. I've also kind of simplified the spreadsheet a little bit too. I got to the point where it started out simple, then it got very complex.
So complex.
Yeah, so complex. Where I'm like, wait a minute, I don't remember what this cell does, and I got to jump around. And now I have simplified it a little bit more, and then brought in the key metrics that I'm looking for. You can get really, really in depth on modeling. The truth is, it's still a pro forma.
Yeah,
and so,
it's still theoretical.
Right. It's theoretical. There's so many things in a deal that can change that you can spend a lot of time and get so granular that it's a waste of time. So in the pre-offer stage, it's typically, full modeling out. I'll model it out over 10 years. But after that, I'm making that offer, and in due diligence, then I'm getting super granular, looking at utility bills, and really breaking it down and figuring a lot of those individual items in each cell and tweaking the model. Once I have a lot more data from the seller, typically I get, if I'm lucky, a rent roll on a napkin and a QuickBooks summary profit and loss of that year. And that's about it, which isn't a whole lot of information to go off of. So a lot of it is just theoretical and what I, from experience, what those things cost. And then once we get into due diligence, get a lot more data, then we can clean it up quite a bit.
Yeah, actually, those are the best, though. You can negotiate more when you get the rent roll on the paper,
Absolutely. And if I get it in the form of an email, it's even better. Usually it's a text message or something, napkin screenshots.
And then, I only take cash for this people, right? So it's not on my tax return. And then in the tax return, you see all kind of expenses all over.
Yes, I used to be afraid of that, and now I see the opportunity in it. Usually when you get really dirty financials or minimal financials, it tells you two things. Number one, there's probably a lot of room to add value and systemize and make this operation more professional. But secondly, it tells you they haven't been considering selling, which tells you then that they haven't, been thinking deep into the numbers and talking to tech brokers. They don't know the market. They don't know the market. So they've got a number in their head that makes them happy, which I love it when my number matches the number that makes them happy. And so it means that you're early to the table to work a deal. And so I do appreciate when someone doesn't have good financials. Rent roll helps, but
that reminded me recently, a couple of months ago, I went to North Carolina market, and I was looking at another mobile home park, and then I saw a nicer one, and I'm like, oh, this is the one I should own. So I went and spoke with the owner, and he was so out of reality. I just, after talking to him, I ran the numbers in my head right away, and I'm like, okay, yeah, I can pay 1.8 to maybe max 2 mil. And he's like, oh yeah, I'm looking for 4 mil. I'm like, we are so far off. There is no way we can do anything.
Why waste another second on this?
Yeah.
And it's funny that you mentioned that, though, because if a seller, and I don't know about you with your experience with this, but if a seller doesn't have a number to start with, I've never put a deal together with them.
Nope.
Ever. I've never made a deal with a seller who didn't have a purchase price that they were willing to give me, because I've realized that there's one of two things happening. They're just curious about the market and they want to see what they can get, or they're going to play games with you to start And almost every time I've ever blindly offered, they go, "Oh, I can't believe that. That's so low." And you're like, "Low to what? You told me how much you wanted." So now I just go, "Hey, I don't want to spend any time making an offer if you don't
Right.
have an idea. I can't make you happy." They usually take your number and then they go
Exactly.
research what they want, and then they always come back higher
Yeah.
because they've talked to 10 brokers. So it's better to wait, spend time with people who at least have a range in mind
Yes. Yeah,
that
I
they
agree.
want.
I agree. So
They
that's
make
why I
somebody
didn't
happy if they don't know what happy means, right?
That's why I didn't even give him my number. I'm like, okay, this guy is so far off. Let him talk to other brokers and figure out. So let's talk about underwriting a little bit more. Who are in your underwriting team, or is that just you?
Yeah, good question. So right now I've got an acquisition manager and a junior acquisition manager. And I also have a part-time underwriter that helps me out with, he's an analyst. And for things that look like we're going into due diligence or we need a second eye on, he'll go and spend a lot more time on
Right.
it. In the due diligence process, he takes all the bills, models, confirms them with the utility companies and plugs them in. So that, and I really am trying to get to the point where I'm not looking at a deal
Yeah.
until late stage where we're about to sign a contract or
Right.
something. Um, Honestly, though, it's back of the napkin by the junior acquisition manager. It's a little bit more time spent by the senior acquisition manager, and then either myself or the analyst is modeling it out.
Got it. No, that's pretty. So let's talk about. Means you go through all this analysis, before getting to the signing table, right, or putting it in the contract.
Mm-hmm.
Do you remember any mistakes you have made during underwriting?
Yeah. Well, do I remember any? Yeah. I mean, I've done it to where I plugged in the utility income for reimbursement, but forgot one of the utilities for expenses. And man, we were crushing it on that deal until we went, wait a minute, we're missing the gas bill, or I can't remember exactly which utility it was, but we had it on the income side. It wasn't gas, it was probably water. And then we added it in later. And we're like, oh crap, we just shaved $30,000 off the NOI just doing that. I think probably the most common mistake that we have made on underwriting is probably guessing either too low on insurance or taxes.
Oh, yes.
Yeah,
That's a
property
big one.
insurance and property taxes, in our initial quick evaluation, or if we're just thrown into a model real quick to see where we're landing, you're guessing. I mean, you
Yes.
really are. And just based on looking at our portfolio, where we own, we go, okay, this is kind of the same region. It's about the same size. We add or subtract a little bit. And we're guessing because we're not going to go
Yeah.
get a quote before we make an offer. And same thing with the taxes. Especially if it's a new state, we're somewhat guessing on that. And then in due
Right.
diligence, we're spending a lot of time talking to the property appraiser, understanding how they value the property each year and all that. And in that case, sometimes that number is very different.
Right. No, that reminds me of my second small multifamily, which I bought on my own 9-unit apartment building. And I was guessing both property taxes and property insurance. When I started getting quotes for the insurance, they were 3 times higher, 3 times. And then I'm like, okay, I may have to kill this deal. And then I went to the same broker who was insuring the property right now, and I was able to get it close. It was still, I would say, 1.5 times because the property value has changed, right? Since the guy bought it 20 years ago.
Yeah, and he's
But
never increased it since then.
exactly. But the property taxes blindsided me a lot. It went up again like about 3.5 times when I changed hands. And there was some when it switched hands, it seems the city realized they were not charging this property for some firefighter union tax. And that
Oh,
was just additional double the amount. And they had not charged it before, but when it switched hands, the city realized. And I'm like, oh, how do you even think about this, right? So,
jeez.
and knock on wood, the deal still made sense. Even right now, I own it, but that was a
Yeah.
big one. It changed all my numbers.
Yeah, it's and I don't know if it's even a mistake because we still kind of make that mistake. It's really
Yeah.
hard to gauge
Right.
those numbers before you go and get quotes and spend the time
Yes.
with the
Yeah.
appraiser. Once you've spent time, the big mistake you can make is not spend time with the property appraiser
Uh-huh.
and not get a good quote in your due diligence.
Right.
That epic, I mean that can kill you. Uh and it's brutal. It's just something that's hard to nail down when you especially in a new market that you've never invested in.
Right.
You just don't know, and you're not going to go bug your insurance agent for every deal you're offering
Right.
them.
Yeah.
They disown you, right? They're like, I don't
Yep.
want you as a
Yep.
client. So I would say that. I'm just trying to think of any other major mistakes that have been made in underwriting. Yeah, I think it's just a lot of little things. You know, you miss something, you get going on it. Oh, here's one. It's not major, but we did this on the last deal we bought. So we're not perfect. We still make mistakes, and I'm willing to admit it.
All of us do.
So get this. We're buying this park, and actually a pretty great park. It needed some work, but it wasn't super heavy roads and some other, trees and not heavy work, but enough. And as we're walking around the property, we're going, man, there's a lot of junk around here. And in the back of the property, there's this massive heap of just crap. And
Oh, wow.
it's bed frames. It's just
Right.
people have been throwing trash back there for years, probably in this one big pile. We note it, we mention it, we talk about it 10 times throughout the due diligence process. What's the one thing we forgot to put a price on getting rid of?
Haul it away.
Yeah, hauling away all the trash around the entire park that
Right.
we complained about for 3
And
days
that's
walking.
such a big pile.
And the bids were coming in at like 20,000,
Whoa,
21,000.
of course.
Massive.
Yeah.
So let me give you the tip on that though. So of course we're like crying because we're getting hit with these huge bids to get rid of all this stuff. And either the manager or our regional manager goes, I'm going to call the fire department and see if they do a controlled burn on this because it's a big enough pile where you'd need a crew. Sure enough, they were willing to come out and do a controlled burn on that pile. It cost us nothing, and then there was just
nothing. Wow, that's crazy.
It cost us nothing to do the controlled burn.
Right.
We had to get maybe 2 dumpsters out there just to pick up
Right.
the remaining stuff, the metal, and get rid
But
of
that's
that.
easy,
And that was
man.
it. So we got saved on that one, but
Yeah.
not always that lucky. Yeah.
No, you got to just keep your eyes and ears open, right? You never
Yes.
know.
The thing that you're talking the most about can sometimes be the most familiar, so you forget to actually write it down, and that's
Right.
and that's where we didn't go get bids on that.
Interesting. What has been your best deal so far?
Oh, man. All right. The best deal full cycle so far was the first park we bought. Thankfully, the first park we bought was a home run. We bought this park, and I don't know how much detail you want me to get into. It seems I know the listener base is pretty sophisticated and advanced investors, so they might get a little more out of the details on this. If it's cool with you, I run through it. So first park, of course, I told you we're looking for apartments, right? And this commercial banker friend of mine calls me and goes, hey, I know you're looking for apartments, but I got this mobile home park and it's in your area. Would you look at it? Sure, I'll look at it. He goes, by the way, it's a note. It's a non-performing loan you can buy on the park. It's not the real estate.
Nice.
Cool, no problem. We bought loans before on residential, so non-performing loans on residential and use that as a strategy to get the asset back. So sweet. I love it. So we ended up looking at the deal. The best part about this deal is that it was in receivership. So all the financials were certified by the court.
Oh, wow.
And they had a receiver, which was doing nothing with the property except for collecting the rent and doing the books. He wasn't managing it all. So the property looked horrible and it wasn't being managed well, but the books were crispy clean because they were being done by this receiver. So we buy the park. We bought the loan, I should say. And one important thing to note about this deal is there was $1 million worth of code enforcement liens on this property, like $1.2 million worth of code enforcement liens.
Wow.
There were a bunch of people that had tried to buy it on a short sale, and they'd get to the point where they were researching it, and then they go, well, crap, I could buy this loan for almost nothing, but I've got all these liens that I can't get around. So by us buying the note, we were then able to foreclose out the liens. And we did pre-closing, or really in our due diligence period, work with the county. We went to them and said, hey, we're going to wipe you out. Obviously, we know that there's violations there. So you can come back in and start by giving us violations and start the whole thing over on us, which we're trying to avoid because we want to clean it up. We ended up negotiating a deal with them to where they wouldn't, and they held to their agreement the whole ownership period that we had it. And so, yeah, we foreclosed out those liens, took back the property, ended up working out a deal with the borrower, had a $4 million personal guarantee. And he was he's a good guy. Wow. He just bought it for a development play and never did it and overpaid by way too much. And so we ended up working out where he paid us to get off the personal guarantee to the tune of about $135,000 or $140,000 to get off the personal guarantee. We bought the park for $750. Now we took off, call it, just for easy numbers, $150. So we're down to $600 basis.
Right.
And then made some improvements from cash flow. It was mostly a management play, not like heavy improvements. We probably spent $70,000 on improvements, not major. And refinanced it, got all of our initial investment out, did not increase the loan amount above what we had into it, and sold it. We bought it in 2015, sold it in 2019 for $6.5 million cash.
Whoa.
So, yeah, whoa. 10 times. It was about 10
That's
times.
That's a good one, man. That's crazy.
Yeah. So it was one of those deals where we kind of said, we really don't want to sell this asset, because if you think about it,
right,
you could have 57 space park, we were cash flowing like crazy on it, but somebody came and offered a price. So we're just like, all right,
no, that's a great price. That's a
the
great
deal.
One.
So
what has been your worst deal, and what did you learn from it?
Really good question. So my worst deal, I'm not going to mention where it is because I still own it.
Okay.
It's a 70 something space park in Florida, and frankly, it's just the area. The area we're aggressively buying. It's just always going to have turnover, because the people in the demographics in the area are not attractive, and it's not to the point where people are shooting each other. It's not like the ghetto. It's just the area is just low income, and it'll always have turnover, a lot more of a renter mentality. And so, we've just had issues with turnover. People buy the homes, but they still just walk like it was a rental. I don't know. They must get money from something, buy the home, and then they still just walk from it when they can't pay the lot rent. And so we just had a lot of turnover there. So we've worked to upgrade the homes more versus selling them with, doing light work. We've upgraded them more, and then we're selling them for a higher price point, which seems kind of the opposite of what you'd want to do. But what we've been working on is just changing the client, the tenant base, getting people who could get financed through 21st. And although they're still not selling for a lot, maybe 25,000, 20,000, the fact that 21st underwrites them and they're willing to go through that process, they've got a down payment, and they're buying something for 25 grand, weeds out a lot of people. It slows down the sales process. And because of that, we've had a slower sales period for each home, but we've improved the quality of the tenant base, kind of one home at a time. And we didn't do that initially. We just kept going with it. We kept having the turnover. And finally we said, we're either going to do one or two things. We're either just going to keep dealing with this, or we're going to bite the bullet and start investing more into the homes and try and get rid of the bottom paying tenants. Right. And it's slowly worked, but it's never going to be a phenomenal park, just purely because of that entire county is just low income. So my learn on that is believe the demographics when you see them. No matter how bad you want to buy a property and expand your portfolio, don't think that your operational abilities can outperform in a market. It's just the demographics are the demographics. If they don't make much money, and they're mostly a renter mentality, you're probably not going to get that strong home ownership vibe in the community. It's just never going to happen.
Right. Oh, that's great. Yeah, and the demographics change takes years. So if you are banking on that, that's gonna take 10, 20 years. So
Yeah, and I mean, if you think about it, I'm talking about a community in Florida.
yes.
Everybody goes, "Oh, Florida's the best
Florida
market."
and Texas, right
Yeah, you
now.
can buy
Yeah, you can't
anything and
go
make
wrong.
money. Yeah, you can make money at it, but you're just going to have so much turnover. It's going to be a
Yeah,
management. It's just management intense is really what
nightmare.
the pain point is on that part. Is management intense.
No, that's great. No, Mario, this was great. So let's switch gears. Are you ready for fire round?
Hit me, I think.
Do you see any impact on the mobile home park industry because of rising interest rates or recession?
Yeah. And you're saying, do I or have I or do I expect what?
Do you see any impact?
Yeah. I think what's happening right now, and we're talking in, September 23rd of 2022 right now. So obviously the date matters for this answer, but interest rates ticking up hasn't created a mass hysteria yet. But what it's doing is it's forcing sellers who have thought about selling or might want to sell to come to the table. They're going,
Right.
all right, this isn't ending. Things are getting worse. Values are going to start going down. If I'm going to sell, I need to sell now. So it's taken sellers that maybe aren't desperate or super motivated, but are going to be motivated or at least have a
Right.
reason to be motivated and gone, all right, I need to start considering selling. So where we were seeing before ridiculous prices,
Right.
just prices that made no sense and weren't really tied to cash flow, all speculation, where it was very difficult to buy things. That's changing. It's becoming a buyer's market now. Sellers are starting to talk reasonable. Cap rates are all of a sudden important again.
Yes.
We're seeing cap rates in the 8s and 9s, which is just
Yeah, that's
mind-boggling.
crazy.
Mind-boggling because 6 months ago, 9 months ago, you have a 9
Yeah.
cap. That's
Yeah,
insane. We're looking at
6,
5
7,
caps.
if
Yeah,
you can get it, that was a good one.
right. People are fighting over 6 and 7 caps. So, I think what's happening is slowly but surely sellers are going to come to the realization that they don't have something that everybody's fighting for anymore. And they're going to have to, negotiate now. And that's healthy. I think it's really healthy. It's good for us as investors. It's opening up the doors for new opportunities. It's also, there's going to be a little bit of gridlock. You're going to see deals kind of buyers and sellers butting
Right.
heads a little bit for a while. But, with a 3/4 point increase from the Fed, yesterday or the day
Yes, day
before,
before yesterday.
people are, I think, are opening up their eyes that, hey, this is just going to get pretty bad. So it also has opened up the discussion for seller financing a lot more,
Yes.
where sellers are going, yeah, I'd work out, if I can get
Yeah,
anywhere
if I want
close
this
to what I
price,
want,
yeah.
I'll work out some seller terms for you.
Right.
So it's actually getting fun again. And not that it wasn't fun, it was just, you felt like you were spending a lot of time
That
on
is
a lot of deals.
that
to
is a lot
maybe
more
get one.
balanced now. That's what I'm thinking.
It feels like you can get deals again. Like we've got
Yes.
multiple deals under contract. We've got a ton of
Nice.
offers out, and it's giving us confidence to offer prices, make offers on deals that maybe we do have a little bit more distance on. And the crazy thing is, we're not getting that, hey, screw you, take a hike. Now we're hearing, well, let us think about this. Let me get back to you. And they're coming
Right.
back with at least counters, trying to work with you because they don't have that flood of people paying ridiculous prices. So that's my answer to the first question.
That's great. Favorite real estate or business or maybe self-development book?
Oh, all right. First one, Bible. It's the best life book and business book you're ever going to read. And it constantly modifies itself no matter the situation you're in. So that's my number one. Number two, Traction. And I always say this when I recommend books. I'm like, man, how do you put a second book behind the Bible? It's kind of tough. But Traction is really good because it's an operational manual on how to operate your company. And we've actually started a company now called Creops that helps commercial real estate investors and management companies and brokerages systemize their company using a system very similar to to traction. And so I highly recommend that book. And there's a bunch more, but that's probably the one that I would say if you're an operator. And one other one, because I know you've got a lot of passive investors that listen here. Am I Being Too Subtle by Sam Zell is a great book. It's a great book because it kind of lets you into the mind.
Yeah,
lets you into the mind of one of the great investors of our time.
Yeah, I agree. Any advice for beginner investors?
Oh, yes. All right. So if you're looking to invest, this is kind of my go-to answer. I might have a couple as I get talking here, but if you're looking to invest in any asset class, but let's just use real estate as an example. A lot of times what people do is they kind of chase the shiny object. They're like, hey, these guys are talking about apartments. They're talking about mobile home parks, storage, retail, industrial, all these different things, single family, multifamily. I mean, you can just keep going. There's so many. Assisted living, just all these different things and niches, renting the rooms, whatever, Airbnb. And it's very difficult to decide where to start. And what I would recommend everybody starts with is what your outlook on the economy and the market is. If you are really optimistic that the economy is going to be strong, people have got a ton of disposable cash, they're going to want luxury and they're willing to pay for it, then you should probably be looking at Class A properties, hotels, Class A apartments, Class A, luxury items, because there's good margins in that, especially when people are willing to spend the money. If you think the economy is going in the direction of, where I think we're all kind of on the same page where it's going right now, it's more obvious. If it's not going to be real good, you probably want to invest in assets that are going to benefit from that type of economy. And believe it or not, there's not a lot of property types that benefit from people not having a lot of money. In 2015, 2014, when we started looking at parks and self-storage, because we do own a little bit of self-storage too, those were the two property types that we were like, man, the economy is going to get bad, because at the time it was great. We thought a couple of years, this thing's going to turn. And so we started buying parks then for that reason, because they do perform very well in down economies, because people just are tight on cash and they need affordable housing more than ever. So I would say first start out with the direction the economy is going for the long, for the next window of time. Position yourself in front of that, and then narrow down the property types from there. But don't be looking at something that isn't going to perform well in the upcoming economy. You're just going to hang yourself, and that's an relatively easy thing to make an assumption on. Second thing, partner with people if you don't want to build it all. I kind of did it. I don't want to say did it the wrong way, but I did it the hard way. I thought that I had to go build out. And as you know, mobile home park world, there's not really a lot of third-party management companies out there that do very good job. So we're used to building out our own property management companies. And obviously we have a dealership, and we've got, these other entities that support our portfolio. And I don't know what happened with my light right there, but anyways, if I was starting all over again, I would figure out what I'm really good at and what I really enjoy doing. And that's, for me, sourcing deals and raising capital. That's where I get excited. That's what I love talking about, right? And so if I could focus on those two and then team up with somebody who's really operationally strong and has that property management company, has the dealership, has some of that infrastructure in place, and just go focus on what I'm good at, I could have scaled much faster than I did. And so one thing that, not to get off track, but one thing that I've done is I'm starting to look at more deals that I can partner with people on and offer that infrastructure that I already have in place to them. So someone who says, I'm really good at sourcing deals, then great, bring the deals, tap into whatever structure I have that you don't want to build out, and we'll create the partnership to where you're doing what you want to do and we do what we're good at, and be able to scale that way, so they can scale quicker, and also I can scale quicker because I've got some leverage with additional partners doing some of the work. So obviously very selective on who we partner with and what deals we go into, but working multiple deals, and recently just closed one like that. So I'm excited about that. So I think people should really consider not making it a one-man one-man army in this industry, especially commercial real estate specifically.
I agree. How can my listeners reach out to you?
I'd say the easiest hub to go to would be mariodattilo.net. And if you can just put that in the show notes or something,
Yes.
it's mariodattilo.net. There you can find my YouTube channel, which is all around mobile home park investing. You can check out all my social media platforms. You can even submit deals to partner with me on. And I know a lot of your listeners are interested in mobile home park investing, and I've got a seller questionnaire that my team has spent since 2015, tweaking and improving. It's a one-sheet seller questionnaire. Every data point you need on a mobile home park to be able to evaluate it, other than obviously financials. And you can download that for free right from my website. And I'd say that's probably the best place to start because all my contact information is there.
Okay, awesome. Thank you so much, Mario, for your time.
Hey, thanks for having me on. This has been a lot of fun. I like getting on shows like this that are technical. You're a technical dude, and I like that because and I like the high level discussions, but many shows are very high level. And when you get into the weeds on the underwriting and how you look at things, I think there's, you ask great questions, and I respect that a lot from an interviewer. So great job, and thanks again for letting me be on.
Thank you so much, Mario, man. Have a good one.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!